Hello and welcome to Investment Insight, your clear take on the markets. Let's get started. So if you're trying to make sense of all the market volatility that we've seen in late 2025, you are definitely in the right place.
It's been a wild ride.
It really has. We've synthesized just massive volumes of recent market analysis, research on structural shifts, geopolitical reports, and our mission today is to distill four incredibly complex, high-impact stories into clear, actionable knowledge for you.
And that's so important because the daily noise right now is a real distraction. I mean, the current market is just characterized by these sharp, often scary movements.
Right.
And then they're followed by this deep, frustrating uncertainty. If you spend all your time just tracking the tick by tick, you completely miss the big picture.
Miss the structural shifts.
Exactly. The institutional behavior that's, really defining the next decade. That's where we need to focus. The deep changes happening just beneath the surface, especially with how that slow, patient money is reacting.
Exactly. And our four pillars for this deep dive, they cover a massive spectrum. We're going from the high-risk, volatile world of crypto to the, highly technical world of life science, then navigating some high-stakes diplomacy, and finally, looking at corporate dominance in the AI race.
A lot to cover.
Yeah. So first up, we're dissecting the recent Bitcoin market crash. We're calling this the turducken segment.
The turducken. I like that.
Because it really involved this complex, overlayered structure that just collapsed under pressure.
Right. If the Bitcoin instability was a fever, this segment is going to explain whether it was just a minor cold or, a major systemic infection. It's a vital analysis for anyone holding on for the long term.
Then second, we're jumping into how AI is completely transforming healthcare. We're calling that the AI factory.
Right.
This is where we identify where the real value is being created. Third, we analyze that critical Trump pay phone call, managing what China is now defining as the red line. And finally, we'll look at Google's really impressive technical comeback in the AI race and its strategic move toward hardware independence.
It's a crucial set of topics. I mean, they're really defining capital flows and risk management for the next 6 to 18 months. So where should we start? Let's start with that recent, pretty brutal turbulence in crypto.
Yeah, let's do it. Let's talk about Bitcoin and that recent instability. For a lot of investors, especially those who came in through the new institutional spot ETFs, that sharp drop felt brutal.
It was.
It started right after the October Trump terror shock, and it led to the most severe downward move we've seen since, the deep 2022 bear market.
Yeah.
When you see your investment drop like that, the natural reaction is just panic.
And that panic is totally understandable, but we need to put it into the proper analytical context. What we're currently seeing in the crypto market flow is what analysts are calling an L-shaped recovery.
An L-shaped recovery. Can you break that down?
Yeah, it's a sharp, swift drop. That's the vertical part of the L. And it's followed by this frustratingly flat consolidation period where the price just seems to hover. It doesn't show any real upward momentum.
So it feels terrible.
It feels terrible because the recovery is so slow, not because the asset itself is failing.
What's fascinating, though, according to the analysis, is what didn't happen during this drop.
That is the key distinction. Unlike the major crashes we saw in 2021 or 2022, this instability did not come from an internal bad event.
Right. No exchange collapsed.
Exactly. There was no sudden unexpected collapse like FTX, no widespread hack or tech failure that fundamentally compromised the asset's security. This wasn't an explosion. It was more like a slow burn.
Okay, so if it wasn't a sudden catastrophic failure, what was the underlying mechanism? What caused that steep drop in the L?
The data points pretty clearly to a structural adjustment. It was a complex fleshing out of built-up pressure driven by three main factors happening all at once. First, you had just persistent global macro uncertainty.
Interest rates, trade wars.
All of it. Stubborn inflation, rising interest rates, the threat of trade wars. When money gets expensive, it leaves the riskier assets first. That's just how it works.
Okay, so that explains the general nervousness, but what was specific to the tech world?
Second, we saw instability in the broader U.S. tech stock sector. And crypto, it often acts like a highly leveraged reflection of the general tech environment. So when big tech pulls back, crypto tends to fall even harder.
And the third factor.
And third, and this was maybe the most painful part, there was a massive liquidation of excessive leverage. Speculators had rushed in using cheap credit to maximize their gains, and when the price started dipping, those highly leveraged positions were automatically sold off.
Creating a downward spiral.
Exactly. It forced the price lower and lower. It was the market cleaning itself out, a necessary washout, you could call it, rather than a catastrophic system failure.
That distinction, a structural adjustment versus a catastrophic failure. That seems really important for anyone listening. It suggests the underlying tech and the foundation are still strong, even if the price action feels terrible.
It is.
But how can we, the individual investor, know for sure that institutions aren't secretly just pulling the plug behind the scenes?
That is a great question, and we have specific, concrete data points that validate that fundamental strength. And it all revolves around what the analysis calls the 4% versus 96% rule for the new spot ETFs.
Okay, let's dive into those numbers.
Yeah.
This sounds really revealing.
This is maybe the most critical insight for anyone holding or even just considering long-term Bitcoin, especially through those regulated ETFs. During the peak of the volatility, we saw about $3.5 billion withdrawn from these institutional ETFs.
And that's the number that hits the headlines. $3.5 billion.
It sounds like a colossal amount of money. It's enough to make any investor jumpy.
For sure.
But here's the analytical punchline. According to the research, that $3.5 billion only represents 4% of the total assets under management, the AUM that were poured into those ETFs in the first place.
Only 4%. So the real overwhelmingly powerful story is the 96% that stayed put.
Precisely. This is where we have to categorize the capital, the 4% that left. We can definitively label that the fast money.
Okay.
This is the short-term, opportunistic, speculative capital. They rushed in right after the ETF launch for quick arbitrage or, short-term gains. They were highly sensitive to fear and were the first to be liquidated or just take profits when the market showed the slightest bit of stress. It's nervous money.
And the 96%, the bulk of the asset base.
That is the slow money. This represents the overwhelming majority of institutional capital. We're talking pension funds, sophisticated wealth management firms, even sovereign funds, and they are hanging tough.
Right.
I mean, they conducted months, sometimes years of extensive due diligence to justify this allocation. They're holding firm, often sitting in loss territory, and that signifies a genuine long-term vision.
So the fact that 96% of that institutional money hasn't sold, that's a powerful signal.
It's an incredibly powerful psychological and statistical anchor. It suggests that the current price level is not a crisis point. It's a level that institutional investors are willing to tolerate for their multi-year conviction.
That puts the volatility into a completely different perspective. I mean, if the big patient players aren't panicking, the individual investor should really take note of that. But the instability wasn't just about ETF outflows. It was compounded by the collapse of these really complex investment vehicles, which the analysis so vividly calls the turducken metaphor.
Ah, the turducken. It's the perfect analogy because it represents just unnecessary complexity built on top of a simple core. In finance, we see these layered structures all the time, just like that Thanksgiving dish, a turkey. Stuffed with a duck, stuffed with a chicken.
And when the market is booming, those layers just amplify the profits.
They do. But when the market corrects, the layers amplify the pain exponentially. And in the crypto world, the turducken was this practice of investing not in the transparent asset itself, like Bitcoin or Ethereum, but in these complex structures built around it.
Right. And specifically, we're talking about investing in what the analysis calls crypto treasury companies, or DATs, often combined with leverage or even SPACs.
Exactly.
So let's pause there because we use that acronym, DAT. What exactly is a crypto treasury company?
Great question. These are publicly traded companies set up with the primary and often the only mandate of holding crypto assets, like Bitcoin, on their balance sheet. Their business model is basically two things: holding the asset and, critically, raising corporate debt against those assets to buy even more.
So you weren't buying direct Bitcoin exposure. You were buying a company whose main asset was Bitcoin, but it also had operational costs, corporate debt, all this accounting uncertainty.
And that complexity relies fundamentally on leverage. So you get all the volatility of Bitcoin, plus the downside risk of corporate debt and management decisions. And when the underlying asset Bitcoin suffers a deep correction, that leverage just amplifies the company with pain far beyond the actual assets drop. The collapse of this complex turducken model was extremely painful for those investors who thought they were getting a safer way to access crypto.
And the analysis gives us a specific, really startling example with MicroStrategy, MSTR, a major holder. They experienced a NAV discount in mid-November. We need to explain that in simple terms because it just reveals the structural flaw of the turducken.
It's a crucial data point. So Imagine MSTR holds $10 billion worth of Bitcoin. If the market saw MSTR as a well-run, functional company, its total market value, its market cap should be $10 billion plus a premium, maybe $11 or $12 billion because the market anticipates future growth and good management.
Okay, makes sense.
A NAV discount means the market cap of MSTR dropped below the actual verifiable value of the Bitcoin it held. So if the Bitcoin was worth $10 billion, the company stock might be trading at, say, $9.5 billion.
That is genuinely astonishing. It means you could literally buy the company's stock for less than the market value of the assets inside it, but the market still refused to pay a premium. Why? Why would that happen?
Because the market was heavily punishing the company for the complexity, the debt, and the liquidity risk. When the market panics, investors hate uncertainty. MSTR holds its Bitcoin using corporate debt, which introduces this element of debt risk and potential margin calls that a simple spot ETF just doesn't have.
And that risk has a name.
It does. It's known as agency risk, the risk that comes with relying on management or a leveraged entity, and that's what the market discounted so heavily. The NAV discount perfectly demonstrated that investors valued the transparent, debt-free asset far more than the leveraged, complex wrapper around it.
Which brings us to our crucial takeaway for you, the listener. Insight number 1, avoid agency risk. This is the core lesson from the turduckens breakdown.
The lesson is clear, and it's about simplification. If you want Bitcoin exposure, buy the transparent regulated asset, the spot ETF, which is what that 96% of slow money is using. Avoid leveraged stocks like the debts.
Because they suffer disproportionately during downturn.
Exactly. Due to accounting uncertainty, corporate debt, and agency risk, which the NAV discount perfectly quantified. Simplicity is robustness in a volatile asset class like this.
So the market has cleaned house. The fast money is out, liquidated by leverage. The slow money is patient. What drives the next movement? Because we know the next rally won't be meme-driven.
Right. The road ahead is much healthier because that speculative froth has been washed out. And the analysis suggests the next rally won't be driven by simple hype or meme behavior like we saw in 2021. It will be driven by substance.
And we can break that substance down into 3 categories that investors need to watch.
Correct. We need to watch 3 fundamental areas that institutional investors really care about. First, Washington. We need regulatory clarity. The anticipation of a potential Trump 2.0 regulatory easing could be a major catalyst.
How so? What would that do?
It would reduce the perceived political and enforcement risk from agencies like the SEC. If institutions feel the regulatory environment is becoming more predictable and favorable, they will allocate more capital. It removes one of the final institutional roadblocks, political risk.
Okay, that makes sense. Second, let's look at Wall Street. We need functional, deep institutional adoption.
And this means more than just the ETF. We're looking for the big banks, your JP Morgans, your Goldmans, to move beyond ETF access and start offering proprietary custody solutions, integrating crypto assets directly into traditional payment rails.
And creating more complex financial products.
Exactly. Options and futures that use Bitcoin as the underlying collateral. That kind of integration validates the asset as a permanent, systemic part of the financial landscape.
And third, the broader macro environment. This is all about liquidity.
It's all about liquidity, genuine shifts in global liquidity. When interest rates finally peak and start to decline, making capital cheaper, that capital will naturally flow out of safer instruments like treasuries and into assets like Bitcoin. Liquidity is the ultimate driver.
So the conclusion of this first segment is really a message of patience and, more importantly, simplification. The analysis suggests simplifying your portfolio to those transparent ETF structures, moving away from the complex turducken-style investments.
And using that 96% institutional holding as your psychological anchor. Don't let the fast money's panic dictate your strategy. Focus on what the slow money is doing. They are patiently, slowly establishing the foundation for the next cycle.
All right, if Bitcoin taught us we need stability, maybe we should look at where capital is being invested for certain long-term exponential growth. And that is the AI factory revolutionizing health and life sciences. The analysis makes it really clear that AI isn't just a marginal improvement in this sector. It's spanning the entire value chain, from initial R&D to drug pricing and market strategy.
This is truly where you see the fusion of technology and biology creating just unprecedented opportunities. When we talk about the AI factory, we mean that AI is becoming the core production mechanism for new treatments. It's about radically shortening the timeline of discovery and massively reducing the failure rate.
So let's look at a specific cutting-edge breakthrough from the sources. The PopEVE AI model, which was announced just recently in November 2025. What makes this model so significant in the R&D process?
PopEVE is a game changer because it addresses the single biggest bottleneck in early-stage R&D, which is just identifying a viable therapeutic target. PopEVE can accurately predict which specific genomic variants are most likely to cause disease, or tragically death, based on these vast data sets.
So instead of manually testing thousands of potential targets in a lab, which takes months or years, the AI basically pre-screens them.
Exactly. For rare genetic diseases, diagnosis and identifying the correct molecular target used to be like searching for a single misidentified brick in a colossal warehouse. PopE instantly narrows the search space down to just a few walls. This radically speeds up diagnosis and target identification.
The efficiency gains are just stunning, but the sources show they extend throughout the entire process. AI is also optimizing the most expensive phase historically, clinical trials.
Clinical trials are where drugs die and budgets just explode. AI is optimizing patient recruitment, finding the perfect group for a trial much faster, and providing far more accurate outcome prediction mid-trial. It can tell researchers which trials are likely to fail sooner, saving billions in wasted effort.
And the market for AI in clinical trials alone is projected to hit, what, $2.4 billion by 2025?
That's right. This isn't just about saving time, it's making the entire process financially sustainable.
The sources also noted a use case that touches on financial engineering, using generative AI for drug pricing and market strategy. This has moved beyond the lab and into the boardroom.
It absolutely has. AI algorithms now analyze these massive, complex data sets on everything from global market demand, the prices of competing drugs, the intricate webs of insurance reimbursement, all to suggest the optimal price for a new drug.
And that influence is getting noticed.
It's gotten so large that the analysis notes it is now under regulatory scrutiny. When an algorithm essentially dictates the cost of a life-saving medicine, it raises obvious market access and ethical questions. It just shows how deeply AI is embedded across the entire drug lifecycle, not just the science.
Given all these capabilities, Big Pharma realizes they can't wait 5 years to build their own AI infrastructure. They're engaging in a high-profile partnership blitz to essentially buy time.
Exactly. The cost and speed required to develop proprietary leading-edge AI infrastructure. It's just prohibitive for companies traditionally focused on chemistry and biology, so they team up with specialized tech providers. And this creates investment opportunities both in the pharma companies making the change and the tech partners enabling it.
We have several crucial case studies detailed in the analysis that illustrate this strategy perfectly. Let's start with the challenge of dirty data, which is highlighted by the Takeda and TetraScience partnership.
Takeda, a massive pharmaceutical giant, had a problem many legacy companies have. Decades of incredible R&D data just sitting in silos in incompatible formats, basically unusable for AI training.
Just sitting there.
Right. So this partnership, launched in October 2023 as the SAIL program, is designed to solve that. TetraScience provides the critical data infrastructure platform. They're the data translator. They clean the data so the AI can actually learn from it without confusion.
And the goal is to speed up drug discovery and shorten those manufacturing cycles, the CMC cycles.
Exactly, where unexpected roadblocks can happen. By cleaning the data, they prevent manufacturing failure later on.
Then we have Eli Lilly and NVIDIA focusing not on data cleaning, but on pure computational horsepower.
Right. Lilly recognized that raw computational power equals speed. They are committed to building an internal AI factory using NVIDIA's top-tier supercomputers. They're effectively betting that whoever can run the most simulations and process the most data the fastest will win the drug discovery race.
And a third example, highlighting a specific global health challenge. GSK, using AI to tackle the rising threat of antimicrobial resistance, or AMR.
GSK made a significant commitment, £45 million, announced in November to the Fleming Initiative. AMR is a global crisis. Traditional antibiotic discovery has stalled. So GSK is deploying advanced AI models to explore chemical spaces that traditional research missed, finding new antibiotics to fight these resistant bacteria. It shows AI being deployed against existential threats.
And the market growth data, it just backs up this massive corporate commitment. We're talking about the global AI drug discovery market surging from around $6.93 billion today to over $16.5 billion by 2034. That's a compound annual growth rate well over 10%.
And pay attention to the geographic growth. The analysis projects an explosive 21.1% CAGR in the Asia-Pacific region. This signals that AI adoption in biotech isn't just a U.S. thing, it's a global competitive necessity.
So if we accept that AI mastery is the new core competency, the question for you, the listener, is how do we invest in it? The analysis offers three crucial insights, starting with a new standard for evaluation.
The old standard evaluating a company purely by its single pipeline drug candidates is just becoming obsolete. It's too risky, too slow. Insight number one is platform power. The most attractive investments are in companies with scalable AI development platforms, not just single drugs.
Why is a platform superior to a single drug?
Because a single drug is a one-shot bet. A platform can discover 10, 20, 50 candidates simultaneously across different areas. Public companies like In Silico Medicine and Schrödinger are prime examples. They own the tech platform that can discover multiple candidates and then license them out. That's a much more robust model.
Okay, Insight 2 focuses on Big Pharma itself, this idea of a re-rating based on AI internalization.
Yes. Investors need to shift their focus. Don't look for the pharma company that just mentions AI. Look for the ones actively integrating it into their core R&D, Eli Lilly, Takeda, Novo Nordisk. By using AI to radically reduce failure rates and cut development costs, these companies will achieve structurally higher, more predictable margins.
And the market will eventually recognize that.
The market will recognize this deep transformation, resulting in a re-rating where their valuation multiple expands as they transform from traditional pharma into these bona fide tech bio firms.
And finally, we can't ignore the indispensable infrastructure provider, the pickaxe in this gold rush.
Insight number three. The pickaxe is still NVIDIA. Despite growth in specialized chips, NVIDIA remains the core infrastructure provider. They specifically offer their platform, BioNeMo, which is tailored for drug development. Since every major AI factory relies on their hardware, including NVIDIA as a core asset in your healthcare AI allocation, it's still a really solid strategy. They get paid no matter who discovers the drug first.
So the final word on healthcare AI is that mastery of the technology is the new core metric. The fusion of biology and technology is driving this renaissance, and those who master the data and platforms will define human health for decades. Let's pivot now to the other end of the risk spectrum, geopolitics. Specifically, that recent critical phone call between President Trump and Xi Jinping. This was a high-stakes event that required exceptionally delicate analysis.
It did. You have to separate the immediate, politically driven economic wins from the persistent underlying security risks. This call was critical because it confirms that despite soaring tensions, both nations are committed to maintaining a dialogue mode. Communication itself is a de-risking mechanism.
Okay, so let's start with the immediate deal, the tangible economic transaction that President Trump quickly confirmed via Truth Social.
The focus was immediately on a specific trade concession designed to address the domestic political landscape. China promised to significantly increase purchases of U.S. soybeans.
Not a random commodity.
Not at all. It is a direct, calculated nod to President Trump's core Farm Belt political base. It offers tangible, immediate economic relief that he can showcase at home as a win.
And beyond just the soybeans, the call reaffirmed the broader agreement they reached in Asia.
Yes. They reaffirmed the one-year trade truce that was agreed upon at the Gyeongju APEC meeting back in October. This effectively buys both economies more runway for stability through most of 2026. And the dialogue track is formalized. A key Chinese liaison is scheduled to visit Washington in December.
So economically, this is like a pause button. However, the analysis shows a significant divergence in how the two sides reported the call, particularly concerning Taiwan. This is where we hit that volatile phrase, the red line.
Absolutely. While the U.S. focused on soybeans and dialogue, Chinese state media, specifically CCTV, emphasized one crucial non-negotiable point. Taiwan is the red line that should not be crossed, and they asserted that President Trump respected this position, which sends a very strong message.
The context of this call is so important for understanding its urgency. This wasn't a regularly scheduled chat. The analysis suggests it was reactive, a preemptive warning from Beijing. Why the sudden emergency nature?
The timing is everything. The call happened right after some extremely firm comments made by the Japanese Prime Minister, hinting at potential military intervention in a Taiwan conflict. China likely interpreted these comments as a significant escalation driven by a U.S. ally and wanted to immediately confirm with President Trump that the U.S. itself would manage its partners and respect the established boundaries.
So the emergency nature of the call just demonstrates the razor-thin margin for error in Northeast Asia right now. The U.S. is actively engaged in high-level situation management.
It is a deeply fragile piece. The conversation manages trade volume to satisfy domestic U.S. political needs, while the fundamental security conflict over Taiwan remains an active, unresolved volcano. That separation economy versus security is the key structural insight for any investor.
Which leads us to the investment strategy. Navigating this uneasy piece requires a strategy of separation. We ride the economic truce while hedging the security risks. So let's look at the immediate economic winners first.
The trade truce offers clear, immediate upside. Insight 1. Economic winners. Since Trump explicitly mentioned soybeans, the entire agriculture sector is a clear beneficiary. This affects soybean prices, corn prices, companies like ADM and Bunge.
A quick cycle economic win, and since things are moving, logistics must benefit.
Exactly. Increased U.S.-China maritime freight volume means the logistics sector, particularly bulk shippers, will see measurable relief. And more broadly, sectors focused on U.S. consumer goods being sold in China, like Nike or Starbucks, also benefit from the removal of that immediate tariff threat.
But the analysis is adamant. This economic piece does not solve the security issue. Insight 2. Security hedges are essential. You can't be all in on the truce.
The Taiwan issue is still the red line. China's warning is real. Therefore, investors cannot afford to ignore the need for hedges. This is the insurance policy you have to maintain.
What are those specific hedges?
First, the defense industry, focusing on contractors like Lockheed Martin. They provide an essential, immediate hedge because any escalation instantly raises their valuation. Second, investors must maintain exposure to companies driving supply chain diversification, those actively expanding manufacturing into India or Southeast Asia. These are crucial long-term insurance policies against disruptions.
So it's a sophisticated dual portfolio strategy. Insight 3 gives us a clear time frame for this.
We need concrete time markers. Use the confirmed April 2026 Trump visit to Beijing as the critical strategic deadline. Until then, both sides have a strong incentive to avoid catastrophic measures like new tariff bombs. For the next 5 to 6 months, market leadership will likely come from corporate earnings and interest rate decisions, not purely from geopolitics.
Before we move on, we have to address the hidden risk flagged by the analysis related to Japan. This is a subtle but crucial factor.
This is where the nuance of diplomacy meets market volatility. If the U.S. acknowledged China's red line on Taiwan, even tacitly, this significantly pressures Japan's government, which has recently taken a very aggressive anti-China stance.
And how does that translate to market risk?
That political pressure could increase volatility in the Japanese yen as investors react to perceived instability in U.S.-Japan coordination. And yen volatility, in turn, can affect geopolitically sensitive sectors of the Japanese stock market. It means investors exposed to Asia have to watch Washington's relationship with Tokyo just as closely as its relationship with Beijing.
A brilliant connection. So, in summary, we have managed peace for now. Buy the commodities, hedge the security risk, and use April 2026 as the deadline for reassessment.
That's the play.
All right, our final segment focuses on Google, or Alphabet. We are moving from a period just last year where Google was seen as trailing in the Gen AI race to a moment where they have made a stunning technical comeback with Gemini 3.0. And crucially, they've paired this software leap with a radical strategy to build their own destiny in hardware.
This is a story of full-stack dominance and strategic independence. Google didn't just catch up. They may have redefined the top tier of AI models and simultaneously challenged the most dominant hardware monopoly in modern tech, NVIDIA.
Let's start with the technical achievement. The arrival of Gemini 3.0 in mid-November. The launch was immediately hailed as a technological leap past the current market leaders.
The performance metrics were genuinely superior. According to external benchmarks, Gemini 3.0 outperformed key rivals, like OpenAI's GPT 5.1 and Anthropic's Claude 3.5 across several critical areas. We're talking superior reasoning, superior coding efficiency, and most importantly, vastly superior multimodal processing.
What does that enhanced multimodal processing mean in practical terms for, say, an average user?
It means the model handles complexity across different media effortlessly. It can seamlessly process information understanding context and nuance when presented with an image, video, and text all at the same time. This is the difference between an AI that reads words and an AI that understands the world.
And this wasn't just internal hype. We saw powerful, independent validation from outside.
Absolutely. The Salesforce CEO, Mark Benioff, was quoted saying the accuracy and speed were insane, and he publicly stated he switched from ChatGPT to Gemini 3.0. When a CEO of that caliber makes a public endorsement of a rival's product, it speaks volumes.
And the market reaction followed immediately.
Of course. Alphabet stock surged to an all-time high of $318 on November 24th, positioning it near that incredibly exclusive $4 trillion market cap club. The market understood that technical superiority in AI is the ultimate driver of future revenue.
But the truly historic element, the one with massive financial implications, is Google's strategy of hardware independence. They are the only big tech firm to officially demonstrate independence from NVIDIA for training their top-tier AI models.
This is the core story for investment analysis because it challenges a monopoly. Google's weapon against NVIDIA's dominance is their custom-designed silicon, the TPU V7 Ironwood.
Okay, can you clarify what a TPU is and why it's different from a standard NVIDIA GPU?
Sure. TPU stands for Tensor Processing Unit. A GPU is a general-purpose powerhouse. A TPU, however, is a custom ASIC. It is purpose-built and highly optimized only for the specific math operations required to train massive AI models like Gemini. Because it's specialized, it can perform those tasks far more efficiently.
So, using this custom 7th-gen chip, Google proved they can create a world-leading AI model without relying on NVIDIA GPUs.
Yes, this is a landmark achievement. It is the first significant scalable crack in NVIDIA's dominance in the AI training market. It gives Google massive strategic leverage. They are immune to NVIDIA's chip price increases or supply chain bottlenecks.
This shifts the market risk dramatically and introduces a key external beneficiary, Broadcom, AVGO. The analysis identifies them as the shadow partner. What's Broadcom's role here?
Broadcom's value lies in their highly specialized expertise in designing and manufacturing custom chips. While Google designs the architecture of the TPU, Broadcom is the indispensable manufacturing engine. They can mass-produce these custom chips at high volumes with extreme precision.
So as Google Cloud expands to capitalize on Gemini, Broadcom sees direct, explosive growth in those custom chip orders.
That's right. Broadcom is the pickaxe maker for all the major players who are now realizing they must build their own custom silicon to compete with NVIDIA. They are a major, though indirect, beneficiary of Google's strategic independence.
We've established the tech edge and the hardware play. Let's briefly review the financial foundation, because the Q3 earnings report released in late October showed unprecedented strength.
The numbers are staggering. They reported record-breaking revenue of $102.3 billion for the quarter, a healthy 16% year-over-year growth. This was the first time they ever surpassed the $100 billion quarterly mark.
And why was that so surprising to the market?
Because there were concerns that ad growth was slowing and the cost of AI development would eat into margins. The Q3 report showed that not only did advertising hold up, but Google Cloud was the undisputed growth engine, surging 34%. This confirmed Google has a diversified, powerful revenue structure.
The technical and financial picture is incredibly strong. Yet there's one major risk that continues to cast a shadow: the DOJ's antitrust lawsuit over advertising technology.
The regulatory cloud has been persistent for years. The DOJ sought the most severe penalty: forced divestiture, a breakup. That's the worst-case scenario that causes some long-term investors to hesitate.
But recent developments suggest that worst-case risk might be mitigating, which is a key insight for evaluation.
Yes. The latest development came from the final arguments on November 21st. The presiding judge expressed clear public skepticism about the feasibility of ordering a forced sale. While a final ruling hasn't been issued, this judicial comment gives the market significant confidence that the worst-case scenario might be avoided.
Okay, let's bring this all together for the listener with the final set of investment insights, starting with the risk mitigation strategy around NVIDIA.
Insight 1. Google is arguably the best NVIDIA hedge. If you're an investor who worries about the concentration risk in NVIDIA concerns over chip prices, supply shortages, Google is structurally immune. If NVIDIA's monopolistic hold weakens, Google benefits disproportionately.
And if direct investment in Google stock feels too intimidating, there is the alternative play we discussed.
Insight 2. Broadcom is an excellent alternative. It serves the custom chip trend not just for Google, but for Meta and others. If the trend is that big tech must design its own silicon, Broadcom is the indispensable manufacturing partner.
Insight 3 focuses on using that very regulatory risk, the DOJ cloud, to your advantage.
This is a classic value investing strategy. The market applies a discount to Google's valuation because of that regulatory cloud. If the risk of a forced breakup subsides, as suggested by recent commentary, that discount could be entirely eliminated. When a discount is eliminated, it leads to a fundamental re-rating of the stock's valuation.
Finally, Let's talk about Google's ultimate moat, the one thing that gives Gemini 3.0 an advantage that no startup can easily replicate.
AI requires fuel, and the necessary fuel is massive amounts of high-quality proprietary data. Google's unrivaled assets search and YouTube provide the superior data source for training models like Gemini. The sheer scale and quality of this data create a deep competitive advantage, a moat that prevents even well-funded startups from breaching Google's position. They have the full stack, the data, the software, and the hardware.
A powerful position indeed. That brings us to the end of our 4 pillars. We moved from the market turbulence in Bitcoin, where we saw the fast money get cleaned out, to the sector transformation in healthcare AI. We navigated the uneasy geopolitics of the Trump she call and finished with the clear technical and hardware winner in Google.
It's a huge amount of concentrated knowledge, and building on that AI theme that dominated our final 2 segments, we should consider the biggest macro implication for the future of innovation.
Which is,
If Google and NVIDIA, the mine owner, and the pickaxe supplier become the only truly indispensable parties for the future of science and technology, what does this concentrated power mean for innovation outside of the big tech sphere? Does this centralization stifle disruptive startups? Or will they simply be acquired and absorbed into these monolithic AI factories?
a fascinating and slightly troubling question to mull over. We've certainly given you plenty to think about for the week ahead, from turduckens to red lines. Don't forget to subscribe and hit that like button.